With the Federal Reserve in their blackout period amidst earnings season, this past week has been nothing but a roller coaster for investors. But what remains clear is that we have, by and large, a future that is uncertain. So you'll want to sit tight and listen up. Now, if you're new here, I'm Ari, a value and dividend investor on YouTube with a mission to simply help you with breaking down our economic backdrop and delivering through on stock ideas. But as for today, I'm throwing in a brief account update before getting into some economic insights and 5 dividend stocks that are worth an add to your watch list right now, considering the level of uncertainty in our future. Before we dive in, I want to take a moment to ask for your help in reaching more dividend investors by simply tapping on that thumbs up button for the YouTube algorithm. And if you haven't already done so, subscribe to join me on the journey. Now, without further ado, let's dive right in. So first things first here, let's knock this account update right out of the park for those of you who have been on the journey with me. Overall, my account is up on the year, coming in at $112,365.08, whereas we entered the year around $102,000, so not too shabby. But I'm going to be honest here, I'm not going to be shocked if my account begins to waver. Why? Well, this is where understanding the economic backdrop comes into play, and in knowing just the macros, it can save you a lot of gut-wrenching emotions and keep you from selling when you really should be holding on to investments or even buying more stocks. So as for this past week, sure, it's earnings season and emotions are running high with plenty of excitement, but do not get distracted. Earnings do not foretell the future. Therefore, it is key to note that the Federal Reserve disappeared into what is known as their blackout period. This means the Fed officials go off the grid and are radio silent till the end of their FOMC meeting, where they then deliver the news of the next interest rate hike decision. That should come at the beginning of May. At this moment, plenty of investors are back to worrying about a recession, and they're hopeful that the Fed will ultimately pause on their interest rate hikes. But I'm going to share now that my opinion may not be one you'll like. You see, before the banking mayhem of Silicon Valley Bank and the banks that fell thereafter, the Federal Reserve was going to hike interest rates by 50 basis points, and once banks began to collapse, the Fed took their foot off the gas and hiked rates by 25 basis points. Now fast forward, we still have a labor market that can withstand an interest rate hike given how robust it is, and because inflation is still sky high, far above the Federal Reserve goal of 2%, I'm here to share that we could very well see another 25 basis point rate hike. Now, if you're asking, well, what does that mean and how will it impact me? In short, the higher interest rates are, the more stressed businesses ultimately become. As operations get more expensive, we then see businesses begin to lay off employees, and of course then consumers have no money to spend, and there we are in one big economic mess of what we call a recession. Now, throughout all of that, stocks are of course volatile. Now, not all companies are created equal, and if we stick to our investment criteria of investing into companies with great leadership, strong brand names, and that are well capitalized, we're actually able to begin to use this time to invest into discounted stocks, which leads us directly to the 5 high quality, incredibly reliable dividend paying stocks, to which I first want to break down Genuine Parts Company, ticker symbol GPC, which is an industrial and automotive replacement parts company that also has segments delivering through on office product and electrical materials as well. Now, think supply and demand here, as a company like this will aim to cut costs, and it's a no-brainer why Genuine Parts Company's share price then is sliding by a little over 3% year to date, trading for $163 per share, which isn't the biggest decline, but that also makes sense as it's a safety stock that investors have been flocking to. As we can see on tip ranks, investors have in fact been adding it to their portfolios. Nonetheless, it currently has a PE ratio coming in at 18.7 and therefore remains quite ripe if you're looking for some safety to invest into. After all, this is a company with an enterprise value well over $26 billion, so it's unlikely to be disappearing anytime soon. Now, of course, based on the uncertainty in the market, we can also see that hedge funds are loading up on the position as well, but I would say it's also great to see analysts so optimistic about Genuine Parts, right now coming up to a share price of $177.83 per share, which makes for about 8% worth of upside, and until it hits that target price, we can collect on a nice 2.2% dividend yield. Up next, and continuing with this notion of an uncertain 2023, I'm here to talk about Caterpillar, ticker symbol CAT. Why? Investors, this is the world's largest manufacturer of construction vehicles and equipment, so as far as I'm concerned, a stock to buy low and literally just hold on to forever, as it will continue to work for you, literally building up and helping to construct a fortress of a dividend portfolio. But the key here is to buy this $115 billion construction juggernaut when it's on sale like now, as it's been sliding on the year, down almost by 10% year to date, trading for about $216 per share, with a PE ratio coming in at 17.3. Now, as for smart money moves, they would be joining you only with 10 times the amount of money that you're investing, as they pour millions into this position. And even analysts are favoring this opportunity right now, coming up to a target share price of $248.42 per share with Caterpillar. That's nearly 15% worth of upside. And until it reaches that target share price, shareholders will be collecting on a 2.11% dividend yield, which is way above the sector average. Moving on to dividend stock number 3 here, I want to once again bring General Dynamics, ticker symbol GD, to your immediate attention. Now, I would actually say that this stock has moved up on the list of stocks to buy for me, not only based on the discount, but sheer reliability, as General Dynamics is an aerospace and defense contractor that is currently the 5th largest defense contractor in the world by arms sales. And with strong demand for weaponry recently, with overall needs from the United States government and allies across the board to continue to increase their arsenal of weaponry, let me tell you, when it comes to General Dynamics, this business is booming. So when it comes to this $58 billion market capitalized defense contractor, that has been sliding on the year by over 12% year to date, whereas it's trading for only $214 per share, I'm here to say add it to your watch list, especially with that PE ratio at 17.6. Now, of course, you won't be doing so alone, as hedge funds will be joining you on investing into this recession-proof opportunity, with analysts also forecasting plenty of upside coming at General Dynamics' way, with the target share price coming up to $271.43 per share, which is over 26% worth of upside. And until we can capitalize on that hefty increase, we can enjoy the dividend of General Dynamics' dividend yield coming in at 2.26%. Up next, I want to jump right into the financial sector, which has been strongly hit recently, but with T. Rowe Price, ticker symbol TROW, we actually see a financial leader that has been struggling without a break over the years for no other reason other than plain old fear. And I say that because T. Rowe Price is a global investment management firm offering funds and financial services, and they've been in business since 1937. Over all this time, they have actually placed an emphasis in investing pretty heavily into the tech sector. So naturally, as big tech has taken a massive hit, and with all the interest rate hikes and the volatility, we see T. Rowe Price continuously sliding, to which it's currently trading for $108 per share. But mark my words, when the economy turns around, this $24+ billion financial player will skyrocket. So why not catch it while its PE ratio is at 16.4? And a matter of fact, that is exactly what smart money has been doing, with Mr. Ray Dalio himself among one of the hedge fund managers doubling down on this opportunity. Now, until we get an economic recovery, the great thing about T. Rowe Price is that we can all enjoy their dividend coming in at a yield of 4.28%. And last but not least here, let's talk real estate with Realty Income, ticker symbol O. Now, it's not exactly at a share price that I love, but it's getting closer and closer to a buy-in price for me to buy more shares. Now, for those of you who don't know of Realty Income, it's a top-notch REIT. As a matter of fact, it's the largest net lease solutions REIT, meaning they don't pay for the properties once they actually lease them out. And check this out, as of right now, their portfolio consists of over 12,000 properties worth of single-tenant commercial units across all 50 states and into the United Kingdom and Spain as well. Now, with over 1,200 clients, they're certainly becoming more reliable by the day. But I personally enjoy Realty Income, as we live in a high inflationary environment, and real estate makes for an ideal investment opportunity to hedge against inflation. Nonetheless, Realty Income share price is currently sitting at $61 per share, which is down from its peak this year of $67 per share. And should it dip below $60 per share, then I'll be buying more shares. As for hedge funds, they're also right here with my thinking and have been scoring more shares worth of Realty Income, and analysts are also shedding some positive light onto this opportunity, coming up to a share price of $69.75 per share, which is just over 13% worth of upside. Until then, well, you're going to be capitalizing on a monthly paying dividend stock with its yield coming in at 4.81%. Now, investors, there you have it, from Genuine Parts Company to Caterpillar, General Dynamics, T. Rowe Price to Realty Income. The 5 dividend stocks that are worth an add to your dividend stock watch list right now? And moreover, a buy, should they fit your dividend investing strategy or portfolio criteria? But now I'd love to know your thoughts on any or all of these dividend stocks and whether they're actually in your portfolio, or if not, then why? And remember, if today's video brought any value to you whatsoever, please tap on that thumbs up button, help spread the word, and join me on this journey by subscribing to the channel. Every single action that you take right now certainly is appreciated and goes a long way in helping me actually grow this channel to reach more dividend investors. Now, until the next video, I will see you all there.